What a day! In the last videos about SEC and Coinbase lawsuit, Andrei Jikh and Graham Stephan talked so much about who's right, who's wrong. I want to give them a credit. They did a really great job, great video, a lot of explanation, but there were few things I disagree with.
You disagree with me on all of this and you have your own opinion.
And I want to share with you folks my opinion.
That's fine.
If you didn't watch this video, I highly recommend to check their videos on Andrei's channel and Graham. In that video, they explain how Coinbase and BlockFi could get under control by SEC and why Lend interest rate and deposit rates are so different. And both Andrei and Graham, while comparing Coinbase Lend interest rate and deposit rates in American banks, pointing that Coinbase profit is almost 10 times higher than banks offer. But they didn't mention the level of risk people taking while investing in crypto and then lending these cryptos to someone else. So we have to compare apples with apples. As with most things in the financial world, when something promises extremely high rates of return, there is usually a catch. Cryptos are high risk and speculative, and it's important for you to understand all the risk associated. Just keep in mind that unexpected changes in market sentiment can lead to sharp and sudden moves in price of crypto. Cryptocurrencies are still unregulated by both governments and central banks. And also there is no perfect way to prevent technical glitches, human error or hacking. But all these problems usually don't happen with the regular banks that we're using on a daily basis. So we are talking about crypto lending. You can easily multiply all these risks twice. So to decide whether to lend your stablecoins or not, think about your risk-reward ratio. That's what Andrei Jikh and Graham Stephan didn't mention in their videos. And this approach is used by many investors to compare the expected returns of trade lend to the amount of risk undertaken to realize this profit. If you want to calculate the risk-reward ratio, just divide the amount you stand to lose if something goes wrong with the amount of profit you expect to have made when you get your profit. Having a solid reward-risk ratio can play a strong role in helping you to manage your actions successfully. So that's my first point. That's the first thought I came with when I watched their videos. So coming back to their videos, rates offered for deposits of Bitcoin, Ether, and especially stablecoins can be pretty high. Currently, centralized crypto lender, for example BlockFi, is offering 7.5%, or Nexo, another company, offers 12%. And compared to these two lenders, Coinbase doesn't look that cool. And what is also important, that these are not entirely risk-free operations, because BlockFi, for example, funding its lending operations and proprietary trading through the sale of unregistered securities in the form of cryptocurrency interest earnings. In other words, the assets being deposited aren't just sitting around, they are being used for relatively risky activities. Remember I told you about multiplying your crypto risk. It's a growing industry. So the way Graham Stephan and Andrei Jikh compares Coinbase or BlockFi lend interest, in my opinion, is not very correct. That's not apples and apples. The second point I disagree with Andrei Jikh is his statement that holding USDC is not an investment of money. Well. He was talking about the Howey test. The Supreme Court has created this test to identify whether certain transactions can be qualified as investment contracts, in other words, security. And according to the Howey test, a transaction is only an investment contract if it's the money investment, if there is an expected profit associated with the investment, if the money investment is a common enterprise, and if profit comes from the third party or promoter's efforts. Coinbase's Lend program easily meets all four prongs of the Howey test. I don't know why Andrew thinks that Lend feature is not investment of money, as Coinbase customers firstly invest money in USDC and then invest coins in Lend program. There's also another possibility that Lend is a node and hence a security. The Supreme Court also established the family resemblance test to determine whether a node is a security. Such analysis requires a consideration of the motivation of seller and buyer, either seller looking for investment or buyer looking for profit. That's a really important crucial question. The second point, the plan of distribution of the node. Is the product being marketed as an investment? The third point, the expectation of the creditor or investor. Would the investment public reasonably expect the application of the securities law to the product? And the last point, the presence of alternative regulation. Will the product be registered as a banking product and the offer registered as a bank? So applying the family resemblance test, we see that BlockFi, Coinbase products looks like an investment product. And no matter that Coinbase derides the vagaries of the SEC definition of security, the definition of security is historically flexible, so as to be capable of adaptation to meet the countless and variable schemes devised by those who seek the use of money of others on the promises of profit. And indeed, by emphasizing elasticity in the regulation of securities, Congress and Supreme Court intentionally anticipated or contemplated the issuers would devise new investment vehicles to raise funds from the public. So don't underestimate the SEC power. They know what they do, even if it looks like they're old school guys. And there are other important things you should know about SEC and Coinbase that Andrei Jikh and Graham Stephan didn't mention in their videos. First of all, the SEC is singling out Coinbase is no accident. The SEC wants to send a loudest programmatic message to change the industry behavior by hitting the highest profile players while using as little of its precise resources as possible. Just keep in mind that Coinbase is the first, but for sure not the last platform that will be regulated. So think twice before putting your money now in such lending programs like Coinbase. And the second thing you have to remember, filter all the information that platforms offer you. Coinbase has not even began lending program, but has began aggressively marketing Lend's benefits to its customer for pre-enrollment, stating all eligible customers are currently invited to pre-enroll for USDC lending by joining their wait list. So they will invite customers of the wait list as the program becomes available. And once you are invited of the wait list, you will automatically start carrying interest on your entire USDC balance. Just please guys, be very careful entering this automatically profitable program. Remember about risk-reward ratio and don't allow anybody to hunt your money. And one more technical thing for you guys to know. SEC has likely undertaken special scrutiny of Coinbase because despite its marketing efforts, Coinbase is not registered exchange with SEC. And indeed, for the typical crypto trading platform, there exists no US federal regulatory framework. It's not just the Wild West. It's not just a new universe. It's a global economic anarchy. So when a customer has a problem with a cryptocurrency transaction, the customer is not afforded the myriad of protections and safeguards afforded by federal registrations. So long story short, unregulated process equals not protected. Hope this will change soon. Despite the fact that Coinbase mocks the unfairness of SEC's mixed bag of crypto-related regulatory pronouncements, but quite to the contrary, SEC crypto-related pronouncements have been exhaustive, comprehensive, transparent, consistent, and steadfast. And indeed, the SEC has gone the extra mile in publicizing its position concerning digital token offerings. Coinbase falls back on that old SEC defense lawyer go-to that using SEC enforcement litigation to make law is wrong. But stark reality is that the litigation is how most securities regulations becomes law in the United States. And the last but not least, I think that's just my guess. Don't sue me, please, Andrei Jikh and Graham Stephan. They are protecting BlockFi and Coinbase and other crypto lending products because they get a lot of money from BlockFi and Coinbase as a referral fees. That's my humble opinion. Thank you for watching this video. As always, don't forget to smash the like button, subscribe if you haven't already, and go to my referral link to open Webull and Robinhood account and get a free stocks. Love you guys, bye.